James Investment Management. He's joining us to take some questions. Matt, great to have you with us here. Thank you very much for your time. Appreciate it. How are things looking, Matt, now? US, just explain the price action. Market interest rates in the US are dropping sharply. I mean, yields are down, the benchmark yield, the 10-year is down 16 basis points in 2 days. And stocks came off as well. So what's the dynamic at work? Markets trying to price in some economic pain going forward?
Hey, Prashant, great to see you and great to talk to you again. And the price action in the U.S., we've just come off a pretty ferocious rally after the CPI data that we got last week. I mean, we had a historic rally across U.S. markets. You hadn't seen those types of gains outside of the pandemic or the global financial crisis, outside of a few instances in the past 50 plus years. So the market is fairly exhausted, and we can't lose sight of the fact that there's still a lot of macro uncertainty. So whenever I'm talking to our clients about how to think through all the different dynamics that are happening in the marketplace, it's really don't chase the market higher, because you're going to have days just like we had today where the market comes down and you're going to have better entry points to get into the market. As we've talked before, I certainly have a more optimistic long-term view, but we're not out of the woods yet. We're so preoccupied on a pivot that we've lost sight of the fact that the terminal rate forecast still hasn't changed. And as a result, it's just too early to be getting really, really optimistic. So I'd say the US is in a recalibration mode. Nothing to be too concerned about, but certainly it highlights again why you don't chase the market higher.
Okay, so don't chase this market. You could get better entry points. Thanks a lot for joining in, Raymond. I wanted your thoughts on what's happening in the US in terms of consumer spending, because the latest we hear is that Target has slashed their forecast on consumer spending. You had FedEx and Amazon do that earlier. Is that a red flag from an equity market standpoint, and how would you read into it?
Yes, yeah, I don't think it's a red flag with respect to equity markets. It's just a reminder that it really matters where you're positioned within the equity markets. And the US consumer is dynamic, it's incredibly broad-based, and there's areas that probably aren't going to be working very well in the near future, and there's areas that continue to work. So we've had a mixed bag of earnings. We had Target this week, but Home Depot and Lowe's both have really good earnings, and everyone's been saying the trend for home renovations, rising rates, people aren't buying new houses, but you continue to see people spend on those different types of items, what people aren't spending on. And I think Walmart earnings corroborate that, is the fact that people don't want to buy more stuff. People are spending more money on experiences. People are going out and doing things, taking vacations, going to see family. We've heard from the airlines that bookings through holiday season and well into 2023 remain strong. So that to me says that the consumer is still healthy. You're not seeing any sort of delinquencies tick up with respect to credit card debt, paying off mortgages. So there really aren't a lot of red flags, but all of these earnings reports, when you take them in totality, is just a reminder that the stocks that you pick matter. You can't just own the basket of consumer discretionary anymore or consumer staples, because there's a lot of idiosyncrasies and you need to know what you're owning.
Hi, Matt. Morning. I recall you were talking about the Indian markets and Latin American markets. They still look pretty good, and you were quite bullish on that. But what about the Chinese market? There's still a lot of uncertainty out there. But everything is good at a particular price. Is that price right now?
Yeah, that's very true. Most things are good at a particular price. You never want to be catching the falling knife. And I would have put China into that category earlier this year. I think from a global perspective, I still prefer the US. I prefer Latin America, Brazil, Mexico. Colombia has been ticking up on my radar from financials and material standpoint. But China does look more interesting, especially if we continue to see some follow through with respect to the zero COVID policy. So China has just been so incredibly oversold really for the past 18 plus months. So from a valuation perspective, it looks very, very compelling. The challenge is, I think there's still going to be issues with Chinese technology. There's still regulatory questions that we don't have answered. So when I look at China, especially around the reopening, I think companies that are a little bit more exposed to, call it the new China economy, the middle class, people going out and being able to spend a little bit more money again, those look more attractive, as do companies that are related to infrastructure spending, areas where we know China is going to continue to invest in order to match the spending that's happening around the rest of the world. So I think China is certainly on my radar. I do not put it above India or Latin America or the US from an investment perspective. But for people who might be willing to take some losses in the near term, the entry point is attractive for the right securities.
The problem with India is valuations are also not cheap anymore, and you do still have global concerns that could have a snowball effect on the Indian market as well. What do you do as an Indian investor now?
I think, just like I said for the US, Sonia, you don't chase the market higher. I think if there's going to be a pullback, if we see a continued pullback in the US, it's going to impact the rest of the world as well. And so you're going to get a better chance to get into the Indian market. And last time we were talking, there's certain sectors within the Indian market that I still like, and I think still look somewhat attractive from a valuation standpoint. So information technology, in particular, the IT services industry that have more exposure to global consulting and offloading of certain practices from the US, such as technology back office operations. With such a big focus on margins, companies are still willing to spend to outsource that so they don't have to pay to do it themselves. So I still think that looks fairly compelling. Financials and industrials, I still think look particularly interesting. But again, I wouldn't be putting fresh money to work when you're sitting near all-time highs. I'd be waiting and being opportunistic with my entry point. But those sectors in particular, I think still offer opportunity.
Okay, Matt, we'll leave it at that. Thanks a lot for joining in, and have a great day. That's the word coming in on the global markets. Let's slip into a quick break on that note. On the other side, our entire list of top 10 stocks will be with you. Stay tuned.